This is the Real Estate Vibe Show, and I'm your host, Vinki Loomba. As a real estate investor and a fund manager, I'm always excited to explore the world of real estate opportunities with you and for you. And today, I'm really excited to welcome back Neal Bawa, a good friend, a remarkable figure in the real estate sector, for his second appearance on our show. For those who missed his first insightful session, I highly recommend listening to the first episode, number 61, titled Level Up Your Real Estate Business with Neal Bawa. Welcome, Neal, to the Real Estate Wife Show.
Thanks for having me back on the show, Vinki. It's great to be here.
Likewise. A little bit about Neal. Neal is famously known as mad scientist of multifamily. Neal's unique approach, combining decades of data science expertise with real estate investment, has led to the creation of a highly profitable portfolio valued at 1 billion with B, wanted to emphasize that, encompasses 30 projects across 10 states. I'm not sure if data is correct or no, Neal, because
It's more or less correct. In fact, I would say probably at this point, the billion's gone down by 100 or 200 million, but luckily I'm not selling anything.
That's good. It'll come up. So Neal is a phenomenal speaker and a master of market analysis. Neal brings a fresh perspective to today's volatile economic landscape. He understands the market disruptions can lead to wealth building opportunities, especially in real estate. And today, Neal is ready to share his unique data-backed predictions for the next 18 months or maybe 24 months, insights that you won't find anywhere else. And our topic for today is, should I buy, invest, or should I wait? And I think this is a critical times that everybody is thinking about this. So let's break down today's economic climate and its impact on the real estate. Everyone is wondering, can the economy avoid a recession? And if it cannot, what would happen? What would the rents look like? Would they go down in recession? Plus, in this current times, or I would say uncertain times, the big question for everyone is, and for me as well, should I invest in real estate now, or is it better to wait and see how things will unfold? So as we look into 2024 and 2025, what are the key trends shaping the multifamily real estate market, Neal?
So we are at a crossroads. Actually, we are recording this in January or Jan-Feb timeframe in 2024, and this is a very interesting time. An extremely interesting time, one that I thought would come many months ago, but now it's finally here. We are at the point where both the market and the Federal Reserve are finally in agreement on something. They're not in agreement on everything, they're in agreement on something important, and that is that the rate hikes are done. More and more of the sitting Fed governors, these are the people that actually set the rates, are saying that they believe that the market, is that they're done and there doesn't need to be any more rate hikes. And a lot of that is because inflation has come down extremely smoothly. 20 months ago, inflation was roaring at 9.2%, which I believe was the highest. And today it's, that level of inflation is under 3%. So there's two different measures of inflation. So it's kind of hard for me to give you one number, but there's PCE, there's core, but looking at both, I think that they're really at 3 or under 3%. And what's impressive is that they are continuing to go down at the same speed as they were 3, 4, 5, 6, or 7 months ago. So that this certainly is not the bottom of the inflation. I think inflation will drop further as time goes on. And what is absolutely mind-bogglingly shocking that no one expected, I certainly didn't, I did not expect what I'm about to say, is that
before we continue, let me take 60 seconds to tell you about Multifamily University. Are you ready to take your real estate investing to the next level? Look no further than Multifamily University. Our comprehensive resources, including guest podcast appearances, educational webinars, the Real Estate Trends Toolkit, and the Location Magic course, are all designed to make smart investing easy and accessible. Plus, with no subscriptions, no upsells, you can trust that we're always looking out for your best interests. But don't take our word for it. Check out what our satisfied customer, Carlos M., had to say. Neal's presentation was filled with invaluable information that is not readily available to the average investor. This group takes you to the elite level of investing. Join the ranks of the elite with Multifamily University. Join us at multifamilyu.com and start investing from a place of knowledge today. Not only will you have access to a wealth of knowledge from industry experts, but you'll also be able to stay ahead of the game with our in-depth analysis of market trends and potential recessions or corrections. Invest with confidence and make informed decisions based on data, not gut feel. Don't miss out. Visit us at multifamilyu.com today or click the link in the description below. And now, back to the content.
This inflation would come down below 3% without a significant reduction in employment, okay? So when the Federal Reserve started cutting rates, US unemployment rates were in the 3.5% range. Depending upon which month you picked, you might pick 3.5, 3.6. Today they are 3.7, which is nothing. There's no differences. The Federal Reserve has cut interest rates or increased interest rates 9 times since I've been tracking the data, 9 times since World War II. And I've looked at all of those instances. And this is the only instance, the one instance where they have reached the peak without a significant reduction in employment. Because what does the Fed do? The Fed obviously wants lower inflation. They like lower inflation. And the Fed has a mandate to keep employment high, right? So what they're doing by increasing interest rates is that they're choosing one of their 2 mandates. One is called price stability, which is low inflation, and the other one is high employment. Those are their 2 mandates. They're written on the door of the Federal Reserve building. And so they've chosen to pick one. They picked price stability, and so they have done a tremendous job over the last 20 months of bringing inflation down from 9% to almost 2%. On the other hand, they sacrificed employment. That is how they bring rates down, because when you create a restrictive environment, it becomes very difficult for the economy to grow quickly. It grows slowly, and in most cases shrinks. So of those 9 times in the past, the Federal Reserve has only managed to avoid a recession once. One time. One single time. The other 8 times, that sacrifice meant that unemployment spiked, often into the 6% range, sometimes even 8 or 9% range. And as a result of those, economic activity slowed. People that don't make money, that are not employed, are not going to spend money. If they don't spend money, then the GDP shrinks and we end up in a recession. That's basically what the Fed does. But what's shocking to everyone, including the Federal Reserve, is that this time we have managed to get to the peak with no real change in employment. And I can't even point to things like, well, unemployment is really at the same level, but, salaries have fallen. That hasn't happened. There's been wage growth of more than 3.5% in the last 12 months. And yeah, 12 months ago, inflation was above that number, but today inflation's below that number. So one could say that today we have positive and real wage growth, right? You want wage growth to be higher than inflation. Inflation's 2%, you want wage growth to be 2.5 or 3. Well, that's what we have today. Today, wage growth is higher than inflation. So not only have we managed to somehow magically, using a wand that I didn't know existed, wave that damn wand and manage to get inflation down without unemployment, we also haven't damaged salaries. We haven't damaged what people are making, because people are still making 3.5% more than they were 12 months ago. And this is what we call the Goldilocks zone. Every economist has a dream to achieve this. The Federal Reserve, since the World War II, has never achieved it. Now, there was this one instance where I mentioned that they didn't put the economy into a recession. It was nothing like today, Vinki, because at that point, GDP shrunk all the way to 0.25, wages were negative, unemployment had gone up to 6.5%, and we just escaped a recession by the breadth of our hair, right? Otherwise, it felt like a recession. Most people would consider it to be a recession. You can't really call this a recession right now. We have 30% more job openings than we have people to fill those job openings, or more like 50%. And so when I look at that, sure, there are individual Americans right now feeling like they're in a recession. In fact, I would say there's millions of Americans that feel like we are in a recession. But when we look at economics, when we look at making money in multifamily, when we look at real estate, we don't look at individuals, right? It's harsh to say that, but it's also truthful. As an investor, when you look at the stock market, right? So the stock market is composed of thousands of stocks across tens of millions of dollars of investors, and everyone looks at the S&P 500 or the Dow Jones Index. Well, now you're looking at things average across tens of millions of investors, and that is the right way to look at it, correct? Well, in the same way, in the real estate market, we can't look at the fact that there's probably 20 million families in America that are hurting right now because they haven't gotten those salary increases. As a whole, America is doing really well. As a whole, the December timeframe, the holiday spend was phenomenal. And as a whole, the unemployment, the filings are continuing to stay low, even though no one expected them to be. A year ago, if I was in a podcast with Vinki Loomba, I was saying that there's a 95% chance of a recession. And the only reason I don't say 100 is it has happened once in the last 80 years, so it could happen again. But I don't really have any faith that we can do this without a recession, simply because the Fed's playbook is push down employment. And that's the only way they've managed to do this. But this time, I have to say, it could be different. I mean, obviously there could still be a recession 3 months from now. So all of this stuff that I'm saying may be wrong. But I can only look at the data that I see today, right? And at the end of January, beginning of Feb of 2024, the data for a soft landing looks remarkably good. Remarkably good. And I hate even saying these words because I feel like I'm saying something that doesn't match my academic background, my data science background when I say these kinds of things. It's like 8 times out of 9, it didn't work. So how could this time be different? But maybe this time is different, right? Maybe there is something to the Federal Reserve's early talk about this inflation being transitory, right? Well, it wasn't transitory, but maybe it was transitory over 18 months and not transitory over 6 months as they thought. So we are possibly in an amazing Goldilocks situation where the economy continues to grow in 2024. I have no doubt, I have absolutely zero doubt that it will grow slower than 2023. No doubt. I have absolutely zero doubt that unemployment will go up from 3.7%. But at this point, if you were to ask me a year ago, I'd say, well, it's probably going to go up to 6%, which hurts. But today, if you were to ask me, well, it's 3.7, I think it probably goes up to 4.5. Well, that's okay. Lots and lots of time, the US economy, 17, 18, 19, look at those times. There's plenty of times when unemployment was in the 4s. That's fine. The nation muddles along, right? And stuff gets done. You saw what happened to real estate prices, even when unemployment was 4.5%, 17, 18, 19, we saw huge increases, right? So 4.5% is highly supportive of real estate investment and stock investment. It's highly supportive of a positive environment. And I think that's where we are going to get by as the bottom of this cycle. When I say bottom, it's actually the top, because what I'm saying is unemployment might go from 3.7 to 4.5, 4.7. And at some point, it really starts to come down again, or maybe just stays at that level. So, it feels like the bottom for people that are unemployed, but it's really the top, right? Well, I think we're going to get to that top in Q3 or Q4 of this year. So there's still going to be more people losing jobs. And you will hear those and you'll panic. You'll be like, Neal Bawa was wrong because, XYZ companies laying off people. Well, they absolutely will do that because the effects of interest rate hikes take 9 months. So the interest rate hike that we had 6 months ago, well, how could it be affecting us right now? It takes 9 months. So the effect of that last 2-3 hikes that we had before we stopped, well, those will be felt in Q1. And as a result, companies will feel a little compressed in Q1, will lay off people in Q2. And so Q3, you see the unemployment rate rise. Normal, right? But the point is, it doesn't look like that's going to lead us into a recession. I think that the United States is doing really well. Now, without being political, Vinki, without being on the left or the right, and I hate doing that, there is a simple fact. The United States recovery from COVID has been the fastest in the world. So I'm comparing us to Canada, Mexico, the entire Eurozone, including England, Japan, China, India. Oh, I have to say India might be an exception to that rule because of where it is in its life cycle. Maybe not a good comparison, but just about anyone else. Our recovery, if you look at our stock market, our GDP in 2021, 22, 23, and 24, we're crushing it, right? So I would like to say, though, I'm not being a fan of Biden. I don't think he did it. I think there were other factors at play here, including what our Federal Reserve is doing, and the fact that the United States is now, once again, the most powerful energy player in the world. We produce, we export more natural gas than anyone in the world. No one's even close. And we are now exporting more oil. We're pumping out more oil than anyone else in the world, including Saudi Arabia. So we're pumping out more oil. We're not exporting more oil than Saudi Arabia because they have a tiny population and we have 330 million people. So a lot of the stuff that we're pumping out, we use ourselves. But that's fine, right? That means we're energy independent. And that has created an incredible shift in the world. I know people are constantly complaining about the fact that the dollar is losing its dominance in the world markets. Well, here's the thing. What was the single biggest benefit of the dollar having dominance in the world market? The single biggest benefit was we had cheap oil from other people. We know in the last 9 years, because of the shale miracle, we now have cheap oil in our own country. And we have the most astonishingly cheap natural gas, right? If you don't understand what I'm saying, I'm going to say this one more time. The United States doesn't have cheap natural gas. We have the most astonishingly cheap natural gas, right? And it's not even subsidized. There are no subsidies on natural gas that I'm aware of. It's just the fact that when we pump oil out of shale, areas, the natural gas comes with it for free, and we've learned how to capture it and sell it, right? But before, we would burn it. Well, for environmental reasons, you're not allowed to flare natural gas anymore. So we're getting better at capturing it. And because we capture a lot, we sell it, and it's ridiculously cheap. The Europeans at this point are paying 3 to 10 times what we pay for natural gas, and we have enough natural gas for 150 years. So the United States has now become energy dominant, not just energy neutral. We become energy dominant, which is why the fact that the dollar is slowly losing its dominance and will continue losing its dominance. It's actually less relevant today than 10 years ago, when we needed the dollar to stay dominant to get cheap oil from other places. We're not buying oil from other people. Other people are buying oil from us. So I think most people don't understand what a massive shift that is and how much of an advantage that gives the United States compared to the rest of the world. I'm not saying I don't want the dollar to be dominant. I'm saying it's not as big of a deal. All right. So I'm looking at the economy and I'm saying this year, the economy is going to support real estate, right? The economy is going to support multifamily. And so, I'll stop here and we can talk about what does that mean for multifamily prices, and also what does it mean for opportunity.
That's true. I think this was a really good synopsis on the market and the economy, because there's a lot more factors that you have to take into consideration. Just not focus on maybe real estate or just focus on stock market only. And plus, look at the technology. We are growing exponentially, and the investors, they have to change their hats too. You cannot think like, living in this age in 2024 and still wearing your primitive hats. So with
You
that,
have to change with the marketplace. I mean, the
exactly,
truth is this: the
exactly.
financial world is so complex now, Vinki, that the only way for you to stay ahead is read every single day, right? So 6 to 7, all I do is read and watch videos, right? And I absolutely do not touch any social media. Social media is not just toxic, it's misleading. Those are two different things, right? It could be toxic and right, but it's not just toxic, it's toxic and wrong. And so I never touch it. I pay for a variety of subscriptions to The Economist, the Wall Street Journal, the New York Times. Obviously, they're all biased, so you have to basically, get rid of their bias and get to the meat of what you're trying to do. When I watch YouTube videos, the moment I sense that anyone's trying to plug it, I click the unsubscribe button, and I make sure that that video never appears in my feed again, because I whatever axe they're grinding, I don't want to hear it, right? So I'm interested in people that are actually looking like me to understand just how complex our world is, and saying, okay, I want to part the leaves here. What's under the leaves, right? I want to hear from people that are naturally curious and say, how can I get rid of political bias and media bias and the bullshit that companies put out, and get to somewhere close to the truth. We can't get to the truth, but we can get somewhere close to the truth. And if you're obsessed with that, I think you'll learn a lot. All of this all of this talk at this point of the United States declining is complete and utter bullshit, because that talk was right 10 years ago, and it just isn't right anymore. There's something about Americans that says we have to bash ourselves, right? And that tendency to bash ourselves can sometimes lead you in the wrong direction. Instead, I suggest that you read the boring financial news that I read.
I know, I agree with you on that too. So, being that said, let's talk about that. How the investors are perceiving these trends is very important, or how should they be perceiving all this information? Like you said, they need to pierce this veil that's been created by the social media, or by all these marketing people out there, because they're spitting out constantly the negative news in a positive way, and people are adding to their stories all that news that they're hearing. And I'm not sure if they completely understand that, how to pierce the way, like you were saying. You subscribe to some phenomenal economist, and then you're trying to pave your way to figure out what is the good news versus just the fake news.
Well, good and bad news. I'm not opposed to bad news.
Bad news.
I just want to know it, right? So if there's bad news, I want to know it even before the good news. So here's thought process. I have 1,000 investors. And one of the things that I've always allowed any of my investors to do is they all get a link, 30 minutes. Whenever they want, they can schedule a call. Some of them, by the way, schedule calls 4 times a year. There's one who schedules it 6 times a year. So he's misusing that link, but that's fine. It's only 1 out of 1,000. And so when I'm talking to investors, instead of telling them about how the projects are doing, the first thing I ask them is, how are you feeling about the market? What is your thinking, right? Because I'm here to get intelligence from them when they're here to get intelligence from me. And what I'm finding is, with a very small number of exceptions, Vinki, all of them are making the exact same mistake they made in 2008. No one's any different. So I'd say of 1,000 investors, there's 10%, maybe a little less, 5%, that are thinking logically. The remaining are being affected by positively or negatively by the last 5 things that they saw on social media or in their email. Right? So they're not able to, unfortunately, pierce the veil. To them, the last thing was the veil, right? And it got pierced. No, there's dozens of veils around that. So I do not understand investor psychology. Well, I should say I understand it, but I get frustrated by how investors think. So here's the reality of the situation, and here's how investors think. So I'm going to contrast these two for you. Okay. Today, investors think it's a terrible time to invest in multifamily. Haven't you seen how prices have gone down in 20%? There's bad news that companies are going out of business, multifamilies are being sold back to the bank. There's people with negative press items. There's a $1.4 trillion cliff coming for commercial real estate. This is a very common thing that gets thrown around. Therefore, the last thing I want to do is be caught in it, right? Well, what's odd is that everything that I just said is true, right? But this is exactly why there's opportunity. What creates opportunity is distress. What creates opportunity is problems. What creates opportunity is a gap between buyer and seller expectations. And also what creates opportunity is temporary stress, right? Temporary stress was caused by the Federal Reserve by raising interest rates. That temporary stress has affected commercial real estate. It's also affected a bunch of other things beyond commercial real estate, right? So it's simply affected things that are interest rate dependent, right? Expensive cars, people are buying less of them because right now when you buy an expensive car, I just bought an expensive car, and the interest rates that they gave me, and I have an 800 credit, was 8%, right? So not a lot of people can afford that at this point. So those things are also getting depressed, but it's a temporary effect designed to kill inflation, and we're doing a really good job of that. Most investors, though, don't understand that that's what creates opportunity. So I want to contrast where we are today with 2008, because most people understand what happened in 2008. And I think that if I have 1,000 investors, all 1,000 of them think that they missed out on 2008, even if they bought something. Like I bought dozens of single family homes, and I was banned from my family parties because they thought that I was infecting the family with my stupid thoughts on real estate, and I would lose all of my money. So I was not allowed to go to family parties for more than a year and a half. And that was good because I spent time buying truckloads of real estate, right? 2008, 2009, 2010. I was just buying everything in sight. But I couldn't understand how other people felt, because I would go to parties and I'd start talking about how much money I'm making, and they would get angry, Vinki. Like they would be like looking at me like, this kid is going to ruin his life, right? And I wasn't a kid then. I was 37 years old, and I knew what I was doing. It was my money. I wasn't their money. I wasn't taking any investors' money, but they would get angry. And I sense that anger from investors today when you tell them that there's an opportunity. But in 2008, right, the amount of risk in the financial system was $8 trillion. $8 trillion, right? And you saw the opportunity that came out of that. People doubled, quadrupled. In my case, my properties that I bought in 2008 have tripled, right? Plus their rents have tripled, which is even better than the price tripling. $8 trillion. Today, the total amount of distress is $1.4 trillion. So firstly, the amount of distress is roughly 16, 17% of what it was in 2008. Second, in 2008, the amount of distress in single family real estate was 8 trillion, because it was really single family that was affected, not multifamily as much. But today, the amount of distress in all of multifamily, the distress that we talk about in multifamily, properties going back to the bank, properties coming up for renewal, that total distress is $90 billion. I'll do the math if you want me to do it, but I've done it on various podcasts. So if you're listening to me, you've heard it, because I've done the math on how many buildings in the United States, what percentage are adjusting, what percentage are at risk, and you multiply that by their value. And if every single one of those buildings goes back to the bank, it's $90 billion. Sounds like a lot. It's 1% of what happened in 2008,
Mm-hmm.
right? Now, it's more than 90 billion for office. For office real estate, the number is in the $300 to $400 billion range. Much bigger problem. But please remember that office leases are not like multifamily. We have 1-year leases. They have 5 to 10-year leases. So it takes a
Mm-hmm.
long time for an office apocalypse to play out. It's not just going to play out in 2024. It's going to play out in 2024, 5, 6, 7, 8. 5 years, there's going to be problems in the office market. So that money, that $1.4 trillion or 360 billion in office gets spread out across a number of years. And if it does happen, we've seen in the past that whenever there's problems in the office market, which is the second largest commercial real estate market, money flows to the first largest, which is multifamily, right? So there's good sides and bad sides to the distress that is happening on the commercial side that people don't understand. So first, investors don't understand that the distress today is a very, very, very tiny fraction of 2008. Second, in 2008, unemployment was 8.5%. Today, unemployment is at 3.7%, up from
Mm-hmm.
3.5% 18 months ago. So the Fed has not affected unemployment. In 2008, people were unemployed. Unemployed people don't buy real estate or invest in real estate. That isn't the case today, right?
Mm-hmm.
We are, salaries are at all times high. The stock market is at all times high. And for some reason, real estate is in a really bad place. Why? Because of what happened in the last 18 months. My point is that that's what creates the opportunity. Today, I am making offers for properties that are 37% from peak. And now it was a short peak. So if I ignore that short peak, I'm making offers 20% below the general prices that we saw in late 2021, mid 2022, right? Ignore the peak because that was Q4 of 2021 and Q1 of 2022. There was a 6-month peak. From
Right.
that peak, I'm making offers 37% cheaper. But from ignoring the top of the peak, I'm still making offers that are 20% below. Well, at any point of time, if I can make offers 20 or 37%, pick your favorite number, below the market, that's
Mm-hmm.
fantastic, especially given that the single family market in the United States is 1% higher than when the Fed started. Magically, the single family market in the United States has not been affected because of what is known as the lock-in effect. People have interest rates locked in at 2%, 3%, 4%. My interest rate is 1.75% locked in for my home. So
Mm-hmm.
I would be completely insane to go buy a multi-million-dollar home at 8% interest rates today, right? So I have no choice. I'm going to stay in my home. Very nice home, but I'm going to stay there, no choice. Well, tens of millions of American families do not have choices and won't have choices for multiple years. Therefore, the lock-in effect, therefore, the single family market as of January, Feb 2024 has gone up 1% since the Fed started. So there's a gap that has emerged. Single family market, extremely overvalued, but you cannot bring the prices down because of the lock-in effect. The multifamily market, which is tied to banks and tied to, to what I call rationality, very
Mm-hmm.
smoothly has declined in prices between 20 and 37%, depending upon how you measure it. That's the opportunity. You're in a market where everything is robust.
Mm-hmm.
That never happens. You either get awful markets with huge number of unemployment people and recessions, and then you get deals during that time, or you get booming markets where everything's really expensive.
Mm-hmm.
Find me one real estate example in the last 50 years that didn't happen, with the exception of today. Find me one example. I will be happy to pay somebody to learn that.
Wow, that's a good comparison, actually. And I really like your analogy, because I think it's more than the analogy, it's the real fact that you're sharing. And most of the time, I just feel like when people are fearful or hesitant, it's just a lack of knowledge because they do not know something and they're hesitant to do it. And thanks
Yeah,
for
and
sharing that.
and
Go
the
ahead.
same thing happens when everything's going up. In
Mm-hmm.
2021, the easiest thing in the world was to raise money. Why? Because the previous 18 months, people had made lots of money, right? Or especially the beginning of 2022. 2021, everyone that invested in multifamily, that sold their multifamily, made huge amounts of money, right? Made me look like a stud. I'm not a stud. I'm just a regular guy, right?
Mm-hmm.
But people are like, wow, you
Yeah.
generated these astonishing returns. I didn't.
Mm-hmm.
The market did, right?
Mm-hmm.
So it's just stupid to think that I have the capability or that anyone else in multifamily has the capability to generate the kind of outrageous returns that are on my website. That was just a time of insanity. And since we had buildings, we sold them. A bunch of people wanted to buy them. We were happy to sell them. So I sold a bunch of my buildings back then. And what's happening is people remember that everyone made money, and so they invest. And now they remember that everyone has quote unquote lost money or been in stress for the last 18 months. So they won't invest. This is the exact opposite of investing. This is known as speculation. 95% of investors are speculators, but no one wants to consider themselves a speculator. Everyone is tied to, well, I use this Excel spreadsheet or I do this, therefore I'm an investor, not a speculator. Use of an Excel spreadsheet does not make you an investor.
I agree on that too. Yeah, this is really good. But let me ask you this question now. So what are your predictions now going into 2024, because we just started the year, 2025 and beyond? What do you see the biggest challenges that the investors are seeing? Because the thing is, because the way the news comes out is like they feel like it's across the board, everything is happening everywhere at the same time, but not necessarily, because each market is different, each sub-market is different, maybe a city, sub-town, everything is different, and there's could be different scenarios, right? That you can use to purchase the property, to hold, or the exit strategy. Everything plays a role into multifamily property, whatever you do. So if you can shed some light on that to demystify for people that whatever you're hearing is not across the board, it could be a different scenario in each market or each sub-market.
Could be, but I think that to some extent I don't agree with you there. So I'll just basically give you what my thoughts are for 2024 and 2025. Multifamily prices have not hit bottom. I expect, because we are now at the peak of interest rate hikes, so I expect that the bottom for multifamily is either going to be Q2 or Q3, and may even be Q4, depending upon how many distressed properties go back in. Remember, the distressed properties are a fraction of overall multifamily market in the United States. A fraction, not even 10%, right? So if every distressed property goes back to the bank, I think you'll probably see multifamily prices bottoming out in Q4. If what I think is going to happen, it might be sometime in late Q2 or Q3 when the bottom comes. I don't wait for the bottom. I follow Warren Buffett. He says Warren Buffett is the greatest investor of all time. And he says, I can't tell bottoms, right? I can only tell when things are cheap. And when they're cheap, I buy them and I keep buying them. So at some point, if I buy here, well, I've bought in a smile, right? And everything in the smile is cheap. But there's also some portion of when I'm buying is the bottom. So I always hit the bottom, but I have a bunch of other investments that are close to the bottom, but never at the bottom. So I sense a bottom coming in 2024 for multifamily prices. I do see there will be distress. We should continue to see cash calls for at least 9 more months, and we will see incredible bargains. So there was an article that came out that I felt like I could have written a few days ago, and it said 2024 is going to go down in commercial real estate history as a benchmark year. 5 years from now, people will be, that was the perfect time to buy. Why? Rates going downwards, economy doing strong, price is cheap, right? So, I mean, everything is cheap right now. I mean, the multifamily is cheap, office is cheap, self-storage and industrial are not cheap, but they're moving in the direction of getting cheaper. So they started their decline later than multifamily did. Multifamily went first because the cap rates were lowest. And so the others are now starting to decline. So I think that by the end of this year, industrial and self-storage should be cheaper, more reasonably priced. They're not now. I think they're overpriced at the moment. And one could even argue that multifamily is overpriced. But if it goes down another 5%, so what? You've already seen a 20% drop, right? So you captured the 20 and missed the 5. I'm happy to do that all the time. That's what investors do. They don't wait for the bottom. They don't wait for everyone to give them good news that they're going to make money. So, prices should go down, should stabilize sometime Q2, Q3, Q4, depending upon what your beliefs are. 2025, rent growth should be weak. So I think rent growth in 2024 is going to be weak. Superstar markets will underperform, and second tier and third tier markets will overperform. So second tier, third tier markets, Rust Belt, places like Columbus, Ohio, are going to do really well. Oklahoma City, superstar cities, which, I have a lot of my portfolio there, all the Texan cities, the Florida cities, Arizona, a bunch of those are going to underperform because the stress on them because of interest rates is higher than the stress on some of these smaller steady eddy markets. So this is 2024 is a year for the steady eddy market, even though there's more bargains in the superstar markets because they are going to be under more stress for the remainder of the year. 2025, I think, will be a quick and rapid recovery. I expect that cap rates are going to start to rebound in 2025. When they rebound, they don't go up, just so you know, cap rates go down when prices go up. So a rebound for cap rates is downward. So we're going to start seeing downward cap rates all through 2025. Every quarter of 2025, you'll see lower and lower and lower cap rates. Will they ever get to the early 2022 level? No. And God forbid that happens, because that was a crazy bubble. And I never want to live in that bubble again. But I think that they'll go back to where they were pre-COVID. So pre-COVID, cap rates were expensive for multifamily, but not as insane as they were in 2021, 2022. So I think we will go back to that, because the Fed wants to take us back to pre-COVID interest rates. So when we go back to pre-COVID interest rates, we're likely to go back to pre-COVID cap rates. And it'll take a while to get there. I don't think we get there in 2025. I think maybe by the end of 2026, we get back to 2018, 2019 levels. So if you want to see what cap rates are, just Google cap rate, Google a chart, look at 2018, 2019. That's where you end up by the end of 2026 from a cap rate perspective. Rent growth should be strong in the second half of 2025. So fairly weak in the first all of 2024 and the first half of 2025 because of incoming supply. Rent growth will get stronger first in the secondary markets that don't have a lot of supply. It will take until the second half of 2025 for rent growth to get stronger in the bigger markets like Austin and and all the other markets that have a lot of incoming supply. And then 2026, I expect a very strong increase in rents across the board, every market in the United States, because 2026 is the month where inventory supply will be low. Why? Because if you didn't start projects in 2023 and 2024, you're not going to finish them in 2026. So that's when there will be a gap, and that'll a chance for rents to grow. So 27, 28 are going to be pretty good times to sell.
Time to get in is right now. So don't wait, I would say, just get in right now. So I agree with you on the market trends that you're sharing. There are still supermarkets, like I was saying the same thing, kind of, there are good markets and bad markets in the current economic condition to where we are today. So the last question I'm going to ask you, for someone who's looking to start investing in the multifamily real estate, what advice would you offer them at this time, how they should navigate in this 2024 and 2025?
There's still some distress in 2024, and I've described it. So the advice for you is this: work with syndicators that are well capitalized. Ask them questions about how much money do they have to put in, how much, ask them for a screenshot of their bank account, or they ask them for a screenshot of their company's bank account. I think that matters a lot these days. It actually didn't matter as much until mid 2022. You could have a syndicator with $100,000 and do quite well, right? But today it matters a great deal, because banks are still going to feel stress throughout 2024, because they've got these multifamily loans going back. They're also going to see commercial loans going back. They're going to feel stress, and that stress is basically gets transferred onto the syndicator, and so they have to be capitalized in various different ways. So my advice is work with syndicators that have substantial amounts of cash reserves, and also work with syndicators that are willing to change their game plan, right? If their game plan was Houston 5 years ago, Houston 2 years ago, and Houston today, I think that's a mistake, because while Houston's an incredible market to invest in, I mean, 5 minutes of research will tell you just how much new supply is coming into Houston in 2024. So you can easily get buried under that supply for 2 or 3 years, right? So there's a bunch of markets with huge amounts of supply, and if the people are sticking to the same plan there, that's a lazy plan, because they just have all the right connections. And they justify it as, well, I get cheaper prices than everybody else. Why does it matter if there's going to be negative rent growth because of incoming supply?
That's good. Thanks for sharing that. So one last question. One last thing I'm going to ask you, one golden nugget for my audience. It's not like that you didn't share enough. What one more golden nugget could be on mindset, could be that could change or shift their perspective towards the market.
Bad news is opportunity. You have to really, really understand that. Bad news is opportunity. And the best way to understand that is not to listen to me, but actually listen to some of the greatest investors of all time, whether it's Audible, whether you're reading a book or watching YouTube videos. All of the glory things that these people are described to have came during bad times. And I think that, there's one thing you have to understand is good news is not good news.
I agree on that. Some kind of awakening happens when you go to the downtown or down markets. So this brings us to a rapid fire round. I'm going to ask you 5 questions. You're going to answer in one word or one sentence only. So I'm going to ask you the first question. What is one of the important things that you've learned in your life? And how did your life change after learning it? Kind of mindset shift right there, I guess.
Get up at 5 o'clock every morning. And I was ready for the day. That's how my life changed.
That's good. So your favorite book that you like to recommend to my audience?
Miracle Morning, for the same reason as the first answer.
Good one. In one word, what does life mean to you?
Joy.
Your biggest passion?
Balance.
I like that. I'm Libra. I always look for balance. If you could turn back in time and talk to your younger self, what would you tell yourself and why?
Take less risk. In certain parts of my life, I took too much risk. I'm telling people to take more risk, but obviously my threshold and theirs is different. I'd say take less risk.
How can people reach out to you, Neal?
The best way is our website. It's called multifamilyu.com. That's multifamily followed by the letter u.com. About 20,000 people come to this website every year. We do 10 webinars a year. Our most popular webinar happens in the next week. So it's at the end of January, beginning of Feb, when we collect all of the data from 50 different sources. We name our favorite cities for 2024 for investing. We name the ones that are trouble. And we basically give you the top 5 trends of the year. Some of them I discussed in this podcast, but not all of them. And so we do 8 of these webinars every year. We don't pitch anything in these webinars. There's no subscription, no upsell, and no education cost. It's always meant to be a free community. So check out multifamilyu.com. And if you're connected to us, maybe one day you'll see one of our projects and you can decide if you want to jump in.
Thanks, Neal. It was a good conversation. I'd love to have you back and pick your mind more. I'm sorry we had limited time today.
It was fun. Thanks so much for having me.